and welcome. Today we are in conversation with Niket Shah, CIO at Motilal Oswal AMC. Let's unpack his investment philosophy, approach to portfolio construction, and views on navigating today's dynamic market landscape. Welcome, Niket.
Thanks, the entire value research team for having me here.
It's great to have you with us. To begin with, Indian equity markets have seen a sharp rally, especially in mid and small caps. Do you believe we are entering a frothy zone or is backed by fundamentals?
So I think I don't think we are really entering into frothy zone as such. Obviously, things are expensive, valuations are expensive, but they're not in a bubble zone as such, where you would think that market will see a crash or something. I don't think we are anywhere near to that. But yes, I mean, are they inexpensive? The answer is yes. Is it difficult to find value? The answer is yes. But I think still there are pockets of growth and pockets of mispricing there in the marketplace, which essentially is what we are trying to do. But having said that, if you look at the last 4 years, for getting ideas and getting themes were far more easier than this year. This year, valuations are very, very expensive. Earnings growth has meaningfully come off from what it was in the last 4 years. And hence, I think to that extent, making higher returns like the way we did in the last 4 years might look slightly more difficult this year.
Niket, as you mentioned about the earnings, do you see earnings growth justifying the current market levels, or are we entering a phase of earnings-led rally or a sentiment-led euphoria?
I think I don't think it's earnings led. Clearly, we've seen last 2 quarters earnings downgrade on FY26 and FY27 earnings expectations for pretty much within Nifty, mid cap, and small cap both. We are not likely to see any meaningful signs of earnings upgrade, at least for the next 3 or 4 quarters. But what is going to be exciting is that when you get into the second quarter of this year, the base effect is slightly lower as compared to the past quarters, where the base effect was far more higher. As last year same time we had an election in June, so 4 quarters prior to election was all guns blazing from government capex standpoint. But I think as we get into second quarter of this year, the lower base starts to come into picture. This also coincides with massive liquidity injection that RBI has done, and obviously it has a lag effect. It starts to play out with a lag effect. It doesn't happen that RBI infuses liquidity and next day onwards economy will start firing all cylinders. So it will take about a quarter or two. Our sense is more like 2 quarters for the effect to be felt on the ground, and which means that market will start doing quite well in the second half of this year.
All right. Sir, your portfolios reflect a high conviction, differentiated approach. How would you define your overall investment style, and what are the key factors you look for when picking a stock?
Yeah, so I think fundamentally we follow QGLB philosophy, which is buying high quality businesses with high growth. Typically for us, about anywhere between 20 to 25% growth is something which we continue to enjoy and like. L stands for longevity of the growth. We don't want, we avoid cyclicals by design. And hence, I think much more structural stories is something that we prefer. And P stands for price, which is valuations. Essentially, the reason why I'm highlighting P much more is in current context where valuations are quite higher, the only way you can get the stocks right is if you're ahead in the curve. If you're not ahead in the curve, then it's quite difficult to actually get enough and more stock selection done from a price standpoint. So you have to be early in the theme where it's undiscovered, and that's where you get the valuation point right. So that's one thing that we continue to do. The second thing that we continue to do is that we continue to focus on companies where the size of opportunity is very, very large, right? And try to be early in the curve where the size of opportunity is very, very large. Look at the inflection points. If there's anything changing around the company, whether it's within the company or whether it's external environment, which is helping the company to grow faster. We also look at industry growth and within the industry growth, which companies are growing at a faster pace. Are they gaining market share or are they losing market share? And last but not the least, it's just cash flows, P&L and balance sheet, but much more focus on cash flows is how we would really kind of summarize broadly what we try to do.
Niket, you mentioned ahead of the curve. Is it basically targeting the sector? I mean, before it comes to the other fund manager ideas. So is it the meaning of that thing?
Yeah, so let me give you an example of what does it mean to be ahead of the curve. For example, food delivery businesses in India were fairly known And obviously, food delivery businesses got listed, they went up, prices went down, so on and so forth. They were not profitable. But I think we could clearly see a huge runway of growth along with profitability. Now, if you look at the time that we bought some of these large food delivery businesses, and they were very, very large part of our allocation across the portfolios. And we actually started to see quarter after quarter meaningful improvement in profitability. And then quick commerce came and so on and so forth, right? So rest is history. So the stock price really went up by about 5 times to 6 times in less than a year or less than an 18 months period from a cost price. Now, that's the good part about it, right? Because you were able to predict this is how earnings will shape up. It played out that way, and you made disproportionate return on capital. At the flip side, now, if you look at next year, we do expect GLP-1s to go generic in India. What is GLP-1? GLP-1 basically are drugs which are weight loss molecules, which is semaglutide, liraglutide. Recently Lilly has already launched it in form of Mounjaro, and you will see more generic version next year as the molecule goes generic in India. It looks like a large amount of pharma companies is going to launch this molecule. Now, this molecule, when you take, fundamentally kills the hunger by about between 60 to 75%. And it will have meaningful ramification on multiple sectors, over the next couple of years as this event plays out. But definitely more on the food and the beverages part of the business. Now, when you see that risk, we acted it 1 year before. We made 6 times money in that same stock. We exited it pretty much at the lifetime high. And we are still waiting to get more clarity on how this event will really play out and impact the businesses. If this event plays out the way we think, it can have meaningful ramifications on growth rates of some of these food businesses, beverages businesses, so on and so forth. And I think it also means that you don't have to be ahead on the curve while buying, but you also have to be ahead of the curve in selling.
Niket, as you rightly mentioned, you gave the example of quick food delivery. During the IPO, the prices went up, then it fell down, and then again it recovered. So, could you just tell us, our viewers, what was the reason? What was the key thing which you thought, this will work for these sectors before, while they were at the bottom level?
Yeah, so I think if you look at an IPO, some of our portfolios had, not most of our portfolios had, and then we had very small allocation. And when I think it kind of got corrected, we meaningfully dialed up on allocation, pretty much at the lowest levels that some of these companies traded at. I think the key thought process were, there were multiple thought processes. One, I think fundamentally food delivery business changes the life of women in India, right? As the woman population of the country continues to work much more than just becoming a housewife. Food delivery fundamentally changes the life of women of India. The second important thing is, this business at scale definitely brings a lot of pricing power to the leader, and which is demonstrated in the form of meaningful increases in delivery charges and in different formats that they charge the customer, and also some increase in take rates that they charge the restaurant guys. So that pricing power was clearly eminent. But I think the elephant in the room was ad. Ad revenues were quite small, and they were expected to meaningfully improve over the next couple of years. And that kind of really played out, which really ramped up the profitability. Now, ad revenues in food delivery played out over a period of 3-4 years. We are seeing far more higher acceleration in ad spend than quick commerce. In food delivery, the partner on the other side who is going to spend on advertisement is a restaurant guy. But in quick commerce, the guy who is going to spend on advertisement are large FMCG companies with a very strong balance sheet and terrific cash balances. So from that standpoint, the size of opportunity for ad within the quick commerce is far more larger than food delivery business. We also expect quick commerce to become far more larger than food delivery. I think it's a consensus view. And I think we also expect tier 2, tier 3 markets to deliver meaningful surprises on quick commerce versus tier 1 markets. As most of these companies enter tier 2, tier 3 markets, the ramp up is far more faster, the profitability is far more better. Some of the quick commerce dark stores, which are older, are actually clocking 9 to 10% margin versus a food delivery business, which is at roughly in the range of 4 to 5% margin. So if you analyze that, you realize that the quick commerce is a larger tsunami than the food delivery business. And that's something that made us quite excited when we looked at that stock from an opportunity size standpoint. There are very few businesses in India where when you buy, they're loss making, but you at least can make a guess or fathom or visualize that they have a potential to make $1 billion of profit. In that case, we just go for the kill, and hence I think our first investment was 9.9% of the AUM for most of the funds, because you very rarely come across that kind of idea, that pricing, and that liquidity that you can get in that stock. So that's how I would summarize.
Niket, now coming specific to the funds thing, you have managed to deliver standout performance across the funds like large cap, multi cap, and flexi cap. What's the common thread of underlying philosophy driving this outperformance?
Yeah, so I think there are two ways to look at it. Fundamentally, for example, if you're very bullish on IT sector, we will look at IT in multiple cuts: mid cap, large cap, small cap. IT within IT services, ER&D, that's another cut. And then within that, there are multiple companies with different growth rates and different leaderships and different size of opportunities. At all points of time, all will not do well. Large caps will have lower growth, mid cap will have higher growth, and small cap might have a slightly more volatile growth. So for us, it was quite important to identify companies which will continue to have structural earnings growth. And hence we kind of figured out that a couple of mid-cap companies that we have in our portfolio will really fit the bill. So that's how we would go about, I would say, some of the stock selection methodology. Second, I think our focus is, we spend disproportionate amount of time to decide what not to buy, right? And that's quite important. Making less mistakes is far more important. I mean, if I have to analyze our mid-cap fund, which is now the highest AUM fund within the organization, there are months and quarters where almost 75 to 80% of the portfolio is beating the index. And we have seen more than a year where almost 65 to 70% of our portfolio is beating index every single day, to give us the performance that we are now looking at. So I think it comes with very, very sharper positioning of the portfolio. It comes with being ahead of the curve. The third thing that we also tend to focus a lot is that, in our opinion, buying is extremely overrated and selling is highly underrated. We focus a lot on what to sell, and at the right time. And last but not the least, our focus is how do you do time management, right? Fundamentally, every fund manager, every individual, whether it's analyst or fund manager, has 24 hours in a day. How do you utilize that 24 hours is quite important. So there are a lot of stuff that we know doesn't fit our style, and we just tend to avoid at the discussion stage. So we end up saving disproportionate amount of time, and that time basically goes to the right areas to identify the next stock or the next theme. So that's how I think utilization of time is quite important in our business. And these are, I think, 4-5 things that comes to top of my mind right now, which I thought I can share with you.
Niket, one more thing. You spoke twice about when to sell. So apart from that QSR example, could you share some of the other examples on you were ahead of the curve in terms of selling also?
Yeah, so there are multiple, right? So I think we used to own the railway ticketing business, the government railway ticketing business, which is a monopolistic business. It's far more easier call to sell because valuation went to 100 times, and 100 times valuation for a PSU was like probably a rare event. So we decided to book profits there. Food delivery, I've mentioned it. We used to own some businesses in capital goods space, which were big turnaround companies. Back down in South, there was a large conglomerate which acquired a company which was a sick company, run by I would say, a reasonably average promoters. They bought them at like $8-9, and then they kind of turned it around, and it's now more than 1 lakh crore market cap. So we made about 30 times money out there. And wherever some of these large allocations have happened, our weights were also quite large. So it's important that first you do detailed research, get conviction. If you believe it's going to be a 5-bagger, 10-bagger, 20-bagger, put larger weights to it. If you like it and if you buy 1% of AUM, it's not going to help you any which ways, right? So that I think is quite important. So then last year we had massive amount of allocation to real estate. And that did quite well, given how we were looking at the cycle of real estate playing out, given the wealth effect which was there in the country. In spite of higher interest rate, the cycle was quite strong. We played that cycle quite well, and then we exited when the valuations were quite expensive. So I think, it's a combination of valuations being expensive. Second is, if you believe earnings are going to be downgraded going forward, that's second reason for us to, effectively go and sell something. And third is, if you just get a better stock in the same sector, then you switch from one stock to another stock. So I think these are the three things that really stand out for us when we decide on how to sell or what to sell or when to sell.
Well, I guess you partially answered our next question. At a time when most large cap funds returned single digits, your large cap fund delivered 20% in 1 year. What, in your view, made that difference?
Yeah, so I think our large cap fund, obviously managed by Atul, did quite well on stock selection. I think we had some stocks that we decided not to buy. They did quite well. Some of the mid cap picks and the small cap picks that is allowed within the 20% part of the AUM, 20% part of the AUM also did extremely well for him. So I would think it's extremely stronger stock selection that really played out last year for that fund. And I think also, lesser mistakes, far lesser mistakes. That was actually the case with that fund. So I think every year, whether it's large cap, mid cap, small cap, multi cap, flexi cap, any of our funds, I think the rule book is quite simple. Just make far lesser mistakes and be more and more sharper and ahead of the curve.
So, Nikhil, could you just explain us elaborately what has worked particularly well in the large cap fund and what were the specific sectors or the stocks that drove the alpha in the fund?
Yeah, so Tag, if you look at the large cap fund today, I think there are a few large weights, whether it's a large bank, it's a large oil and gas player. You can always avoid them if there is lower growth, right? And if they don't do well, you basically 20-25% of your AUM, which is ideally supposed to dedicate to them because they're larger weights in the index as well. And if you don't have that weight and you use that weight somewhere else where the capital grows, is how you basically end up making meaningful amount of alpha generation. So we had that call that some of the large banks, some of the leaders in the banking space, which were not doing well for the merger that they had, we avoided that. We also, had a clear strategy of moving slightly more towards the mid and the small cap space where there was far more interesting ideas. So that's about 20% of the AUM, which obviously benefited. And then there were selective IPOs in that year. So that also kind of played a bit role. So all accumulation of all of that is the result that we continue to see.
So, how much weight do benchmarks hold in your allocation calls across categories?
Yeah, we are very, very aware about our benchmarks, sector benchmarks within the sector, stock benchmarks, and so on and so forth. But having said that, I think if we get a situation where we know we have struck gold, we just go for 9.9, one shot. We don't think multiple times that what should be the weight that we want to buy. If you strike gold, just go for 9.9. That's the maximum that SEBI allows you. So we don't shy away from that. But to go for 9.9 requires tremendous amount of work. Only when you do that tremendous amount of work yourself, you get that conviction to go for 9.9. Otherwise, it can't happen on borrowed conviction. If someone else will tell you, some sell side will write a research report, you will not go to 9.9. You'll always be worried because you are not on the top of the subject. You need to be on the top of the subject, and hence only, and then you can get conviction, and then you can go for that larger weight allocation. Without that, I think it's quite difficult and unnerving. I mean, there are companies where, for example, some of my colleagues would have done a very good job. I wouldn't have spent enough and more time on that. I wouldn't go to 9.9 in that stocks. I would go to say 3 or 4%. In some of those stocks. So if I would have done work on something which is like the food delivery business, where I was very closely associated, doing a lot of work, I was on the ground. I actually was driving with the riders in Mumbai, Delhi, so on and so forth. So only when you have detailing and granularity of understanding, you get conviction, and that conviction then gets translated into larger weights.
Your high conviction approach has worked well in a trending market, but this year's volatility and correction seems to have tested the strategy. So, how do you navigate the period when markets turn choppy or volatile? And does your approach evolve, or do you prefer to stay the course? What is the key learning from those phases?
Yeah, so it'll evolve. It'll not remain static. We don't like to keep portfolio static. We don't like to keep strategy static. And it's a evolving situation. Markets are evolving, and we have to be flexible. If you're not flexible, I think fundamentally you'll underperform. And we do have to take calls, right? That's a good and the bad part of the business, that you have to take some strategic calls in life. We took a strategic call in Jan this year that looks like this year we will see earnings downgrade, which we haven't seen the last 4 years. And hence we will go far more defensive this year on markets and our allocation, our stock selection, so on and so forth. And fundamentally, we decided the first 6 months will be tougher. The second 6 months will be far more stronger. Obviously, we're coming to end the first 6 months, so looks like second 6 months should be better. And we've seen that playing out, right? All kinds of stuff happening in the world right now, geopolitical to tariff and so on and so forth. Fundamentally, we decided to have slightly larger cash because we were getting ideation was tough this year. And at the value that we think, given the uncertainty and the ability for us to project earnings, was also a bit tougher. We said that let's let this all play out. Let us see what the impact on earnings is and how the corporate India, kind of navigates this. And after, watching for 3-6 months, we will take informed decision rather than making a guesstimate in the initial part of the year, oh, this will do well or that will do well. But you have no idea, there are so much uncertainties around. So I think there are times, fundamentally, I think the most important part to keep in mind is mutual fund businesses or managers need to understand that mutual fund is all about risk management. Is as much about buying right stocks, making money, selling them right, but it's also about risk management. Last 4 years, we were like, in some sense, we say internally that we were batting like Sehwag. But this first 6 months is like Dravid, right? You have to be Dravid. And then you basically move gears, right? As in when you feel that the cloud are much clearer. And the good part about the business is that it allows you that flexibility to move either side quite fast. And we are a far more younger team, and we are probably the most agile, and we move very, very fast. So once we have made our mind, we'll move like at lightning speed. So that's quite important because if you're stuck with a mindset or a zone, even if you're going wrong, you should accept it and move forward in life. And we are all human beings at the end of the day. We all make mistakes. So there are learnings from the mistakes as well.
So Niket, basically, the performance of the 6 months, which has been little bit behind the curve, is only because of the high cash calls.
That's correct. Some of high cash calls that we had is very strategic in nature. We wanted to see the market. We wanted to see how earnings growth will play out. And at an appropriate time, we will deploy it as and when we get the right set of ideas, from a risk-reward standpoint.
So basically, it's a tactical call on the valuation.
It's just valuation call. I mean, it's just impossible to get value. For us to even make like some 20% return, to even justify internally that I'm buying a stock X, this will give me 20% return. I mean, your starting point is like 70p, 60p, 50p, where companies with high growth, impossible to justify. And hence, I think it's okay if you can't justify, just don't throw capital anywhere. We don't participate in blocks like the way it's happening. Every day there are blocks, every day there's QIPs. There are companies where fundamentally our view is massively negative. We fundamentally believe there's huge crash crunch to that business. And they come up with a QIP, the QIP gets upsized by 2 times and the demand is 6 times. And we just can't understand where is this all happening and what's happening. So it's okay if you can't understand, just stay away. And whatever you understand, you should do that. So fundamentally, our first 6 months was making less mistakes. Second 6 months would be far more aggressive.
Well, a consistent mid-cap tilt is visible even in your flexi-cap and large-cap funds. Can you walk us through the thought process behind this positioning?
So I think fundamentally, when you look at mid-caps, anything which is like in the range of 80,000-90,000 crores in terms of market cap also is now mid-cap, but technically in earlier times, it was called large caps. I would say that they are larger mid-caps. And that's a bit of a sweeter spot for some of our large cap funds. Companies with a profitability of north of 2,000 crores has a potential to grow at a faster pace. Is something that we continue to like a lot. rather than companies which are already at 6,000 crores or 5,000 crores, 7,000 crores of profitability. The growth rates will be lower there. So I think we try to go one step down without compromising on quality to achieve a slightly higher earnings growth for the portfolio. So that's, I think, the reason why we would continue to focus a little more on larger mid caps. Within small caps, we've generally been very, very picky and choosy. We generally go into small caps only when there's a large theme playing out, where we believe that, again, we have struck gold. Like, so if you look at some of our multi-cap fund or business cycle fund, some of the large allocation that we have to small cap funds is on a specific theme that we are playing for. Very, very thought out, very, very detailed, worked out. Only then we will really go into it. So I think those are the nuances, because in small cap, if you make a mistake, just there's no exit because it's quite illiquid. So if you get in, you better be sure. And if you're not sure, don't get in. Move to larger mid caps, move to smaller mid caps. But if you go to small caps, you have to be very, very sure of what you're doing.
Niket, now, you have taken some bold calls, well, 65% of the flexi cap in the top 10 stocks. The total stock of the fund stands at around 21, 22 stocks. So what gives you confidence to take such a concentrated bets? And, is it purely earnings visibility, or are there any conviction triggers too?
No, I think first and the fundamental reason of me taking that call is, first of all, that 10 stocks become a 65 is not day one, right? It's by design, because some of our stocks have become 5 times, 10 times, and hence mark to market gains also contribute to that. So that's the first point. The second point of, even right now as we speak, if 10 stocks are 65% of AUM, we're extremely comfortable with that. Because fundamentally, I personally worked on them, and hence there's very high conviction on them. There's visibility of growth in a bad environment. So if they continue to grow at 20-25% plus earnings growth, which is basically compounding your profit by 2 times in every 2.5, 3 years, it's something which we are quite comfortable with. And as and when the cycle turns, I think the growth rates move up if the management is quite dynamic. So we focus a lot on quality of management. And obviously quality of business is also important, but quality of management is far more important. You can have a great business, but a bad management, and still not going to get the outcome that you would desire for.
So, with such high concentration, how do you manage risk if a few big bets don't play out?
Yeah, it's not played. It's not work. It's not actually happened to us in the last 5 years, so I can't answer that question. So far, we've been fairly agile on the stocks that we bought. We have been on top of the game on selling. If you look at last 5 years, and if you analyze the fact sheet, at multiple points of time, different stocks were 10%, 12% weight. Some of them don't exist in the fund, and we would have exited pretty much at lifetime highs, or maybe 5 or 7% away from lifetime highs. So it's quite important to analyze that we've bought companies. They have done extremely well. Some of them have become 30 times for us. We've exited them at the top and moved to something else in life, and that is again repeated. So we want to repeat the same virtuous cycle again and again. Having said that, I think there are times where we take a call like we took in this 6 months just to be defensive, because it's quite unclear of what's happening in the world. And with larger funds, you don't want to take that chance because you don't want to position it wrongly and then reposition it and so on and so forth. So we took that call that we will protect the NAV for the first 6 months. The focus was just to protect the NAV. It doesn't matter what underperformance comes, just protect the NAV. So that is one way of doing risk management, right? If you believe that some of the stuff is not doing very well. The third thing is that if you know, for example, one of a large holding is not going to do well, no problem, liquidate it. There are ways to liquidate, right? And you book out, don't carry the stress, don't carry the baggage of underperformance for a longer period of time. The earlier you do, the better. It's all about mindset. I have bought stocks with a certain thought process and certain projections of earnings, and they've not delivered it. I have sold it at a loss. And it's perfectly fine. I think till the time you understand that the value of capital is far more important if it remains at the same level as underperform. It's important that you move out of it and go to something where it's outperform. So I've seen in the last 5 years, if the tree of underperformance grows, it's important to act early. If you allow it to grow bigger and bigger, the problem will only compound manifold. And then it takes 2-3 years to 2-3 years of good work to go back to the same level. So that's how broadly we look at it.
What should investors keep in mind while staying invested in the high conviction benchmark agnostic fund like yours?
No, I think fundamentally what they have to keep in mind is that we are human beings. We will make mistakes. Last 4 years are not a reflection on the next 4 years. It can be better than last 4 years as well. And it can be worse than last 4 years as well. But having said that, I mean, we keep saying it all the time, but frankly speaking, we don't see that in customer behavior. Is that you have to invest for at least 3 to 5 years for you to benefit from one cycle. We don't look at markets. I mean, I've kind of get that question that did you guys think that the market will go down, hence you had a cash call? I said no, we don't buy Nifty. Nifty is not a part of our portfolio. We buy stocks, and fundamentally we have views on stocks, and that can be right or wrong, but we have views on every stock under the coverage list that we have. So I think it's quite important that investors continue to play from cycle to cycle. And that's how at least I do, tell some of the close friends when they look at investment is that the best time to invest is in the bad market. And the simple way to look at it is like, for example, you go to any of the e-commerce companies. If they discount the product by 50%, you buy more. But you don't do the same thing in equities. I don't know why. Right? If equities go down by 20%, you should frankly buy more logically because it's cheaper by 20%. Unless you have a fantastic view that you believe it will further go down, so be it. But that's always the case with e-commerce as well, right? You could get something at 40% lower today, it might be 50% lower tomorrow. So fundamentally, in businesses where things get cheaper, you buy more. Why not with equities? Have the same mindset.
So how do you approach the diversification across sectors when your portfolio is already concentrated in few stocks?
Yeah, so fundamentally, the way we look at it is that first we do take a call on the sector or the theme, and it's quite important to take that call whether that sector or the theme will do well for the year. If you believe it will do well, for example, say let's take IT. If IT is going to do well, what within IT is something that we look to buy? Now, if all the stocks in IT are going to do well, I want to buy the top two. Simple, right? I don't want, like for example, there's company A, B, C, and D. 4 companies in the IT space, all of them are going to go up by 20%, but 2 of them are going to go by 30%. I want to own those 2. Simple. That's very, very simple. So we ideally focus a disproportionate amount of energy to figure out that which are the highest return stock of that theme or the sector. And that is what we need to own. It doesn't mean that the other companies are bad or they're not going to do well. They will do well as well during the same time, given the fact that sector is in tailwind. But if there is a company which is going to give the highest return, I want to be a part of that. It has to be a part of my portfolio.
So, are there any metrics or frameworks besides earning and valuation you rely on to judge longevity of a business?
So, I think longevity of the business, there is no formula. There's no quantitative formula for it. It also depends on the mode of the business, how moated the business is. And I think that essentially gives you the confidence that if the mode of the business is quite strong, then it's likely to sustain for a longer period of time, right? So we spend a disproportionate amount of time on understanding the mode of the business, what's the right to win for that business or for that company for that matter. And that will give you that confidence that this will sustain. The second thing is execution skill set. Fundamentally, same businesses with 2 different managers will have different outcomes, right? So are you agile? Like for example, one of the food company, let's take example, food delivery business. The leader is quite agile in everything. The number 2, number 3, I'm not sure, as compared to number 2 and number 3, but they're good. The number 2 is extremely good as well. No doubts about it. So the fact of the matter is 2 good businesses, very good quality promoters, but just the first one is slightly more agile and more sharper and more faster and more aggressive than the first one. So then the second one would make that difference in financial numbers.
Niket, now very few things on the mid cap thing. The mid cap fund has also done reasonably well in the last 1 year or so. So what has worked for this fund, and could you again share with us some of the key triggers which has worked very well for the fund from the sector allocation or the stock selection process?
Yeah, I think I can't get into names or attributions, not allowed from compliance standpoint, but fundamentally, I think tech has done quite well for us. The mid-cap tech has done extremely well for us. Our positioning was quite sharper and the right place, right time. We avoided meaningful amount of mistakes last year. Food delivery businesses benefited us in a meaningful fashion last year. Some of the food delivery and quick commerce, some of the retail businesses and consumer discretionary businesses also benefited us last year, which is something that we are seeing this year as well.
So just wanted to understand, in the multi-cap fund, how do you approach the 25% allocation with the 25%, with the what factors, valuations or markets cycles, liquidity drive those, 25% allocation?
The way we look at multi-cap fund is that we look at the best ideas in the large, mid and small space, right? So that takes 25 to each. So for example, there's large cap, there are 100 stocks. Within that 100 stocks, I have to just allocate 25%. And we run concentrated portfolios. So at best, we'll buy five stocks of 5% each, right? Now, fundamentally, when you are to buy 5 stocks out of that 100, it's a far more easier job. The focus is only that we have to make more money without compromising on quality, right? Clear focus. More money, if you want to make, in the business needs to have higher growth. For example, telecom. 2 years back, we were massively over telecom, and it benefited us in a big way. In the last 1.5 years, we expected 2 price increases. One has played out. Second one should play out this year sometime or early next year. So I think you will see a full benefit of telecom cycle being played out by us on the large cap side. So when you keep those things in mind, you will end up realizing that it's not so difficult to get 5 or 6 top ideas within the large cap space, mid cap space, and small cap space. Small cap space is slightly more granular, would generally prefer 7, 8 ideas because of liquidity. But otherwise, getting 5 large cap ideas or 5 or 6 small cap, mid cap ideas is extremely easy. In a good year, this year is tough, but in a good year, where valuation is much more reasonable, it's far more easier. So it's the way we look at multi-cap fund is in some senses, house best ideas within the large, mid, and small is what really goes into it.
So, sir, your portfolios generally show a strong growth bias and trade at a higher PEs other than your peers. Is this by design? Does this reflect a bullish long-term outlook? Any plans considering launching a value-oriented fund?
Yeah, we don't have value-oriented fund on the MF side as such. We do have on the PMS side. But to answer your first question, I think the portfolio PE look expensive. It's a factor of mix. I can get a portfolio P to less than 15 just by all metal companies, 100% metal companies. It will be less than 15 P. And if you buy all the consumer companies, it will be like 75 DP, right? So the factor of mix of the portfolio, how away you are from financials, will also determine the PE of the portfolio. So for example, we are actually zero weight on banks in some of our portfolios. So banks don't trade at 75 PE, right? So fundamentally, that's one lever which some of our peers would definitely have. Some banks in their portfolio, so their PE obviously comes down, but then the growth of the portfolio also comes down. For us, what's important is growth of the portfolio. It's quite important, and at the right valuation, again, that's quite important. So I think the mix of the portfolio for us is more focused on mid-cap IT, more focused on consumer discretionary, more focused on manufacturing. All of these 3 are, by design, they're high P sectors. So if you have a large amount of allocation out there, what happens, it leads to very strong growth of the portfolio, obviously with slightly higher valuation, and it still benefits.
So Niket, the last one before we wrap up this chat, most of your active equity funds like ELSs, large and mid cap, flexi cap, or even the mid and small cap follow a focused strategy of around 20 to 30 stocks. Interestingly, while many of these funds have delivered strong 1-year returns, the dedicated focused fund has lagged, sitting in the bottom quartile. So what's the reason for that? And, what's the road ahead for this fund?
So I think, fundamentally, we give a lot of freedom to individual managers. Every manager of the fund, whether it's the fund that I manage, whether the fund that Ajay manages, or Atul manages, or the earlier fund manager, there's enough and more freedom given. Sometimes it does happen that the strategy that we think are executed by most of the fund managers, sometimes it doesn't happen. So I would think whatever worked for all the other funds didn't work for this fund. So stock selection was wrong, sector selection was wrong, weight selection was wrong. We sold early. We did probably all possible mistakes I can think of. So I think it does happen. We have taken course correction. The managers have changed for that fund as the earlier managers left. So obviously the new set of managers will take it, or has already taken it over. The balance advantage was taken by me. So we have made those necessary changes that we desired to do it. And yeah, that's something that it was quite important for us to do this year. So we've done that course correction completely now. So hopefully those couple of funds which were lagging behind should also start joining the party.
Well, that was great talking to you, sir. Thank you for all your time and great insights.
So much. Thanks so much for having me here. Thank you.
Thank you.